Tune in to the FinTech Files for exclusive interviews with FinTech executives and thought leaders. We will talk about how the industry will overcome the crisis that has marked the start of the decade, how it can be part of the solution, and how the financial world will evolve in the next decade. This is your host, George Alaferis from Arama.
This episode has led to fascinating discoveries about what is actually possible to change in real life by using digital assets and technology. From the way SMEs can finance themselves to the way people can get access to banking services, everything can be transformed in a meaningful and positive way. Enjoy this conversation with Hirander Misra, who's been a financial innovator for decades and now leads various ventures into the future of exchanges and financing. Hirander, welcome to the show.
My pleasure, George.
Where are you confined and what's your working from home setup?
So I'm in the northwest London suburbs in a place called Northwood, which is between Pinner and Watford. And luckily, because I'm quite used to working in different places, like working from home, our city office in the Royal Exchange, but also abroad, I've got a good home setup. So right behind me, I've got a big whiteboard and Wi-Fi is relatively good. And there's a really good office environment. So I can lock myself away from screaming children and everything else, and then just get on with it, really.
Oh, fantastic. I wish I could say the same. I don't have such a good setup, but I kind of managed to get on with it, with screaming children often coming in the background, but that's okay. We're all getting used to it, as we were discussing before. And can I just start as well by asking how the lockdown affects you personally and professionally?
Yeah, I mean, it's been a change in the when on the one hand, whilst there's no commute, there's no beginning and there's no end of the day. So you've almost got to kind of orchestrate that because it can start a lot earlier and go on a lot later, and also making that distinction between the week and the weekend as well is also sometimes challenging. But on the other hand, I've actually spent more time with the children and things like that than I ever have before. And usually I'm on a plane half the time, traveling somewhere, and obviously in the city, and then you're at home mainly at the weekend. Actually, from a family bonding standpoint with the kids, it's been amazing as well and somewhat liberating.
Yeah, fantastic. That's good to hear. So let's start about a bit about your career, and it spans. I've seen many high-profile jobs. I would say you've been in the cutting edge of financial technology, maybe even before it was called FinTech. I don't mean to age you. You're not
Yeah.
but how did you get into that space, finance and financial technology, and why did you choose that?
Sure. So from an early age, with privatization in the UK and the Thatcher era, my father started to get into investing in publicly listed companies. At the time, it was British Gas, TSB, and other initial public offerings. And I remember him looking at teletext because that was the only means of looking at share prices if you're a retail investor at that time. I got really interested in that. And then, at school, when I was relatively young in my early teens, a stock trading game was introduced where every week we'd pick stocks and then we'd value them every Thursday. So I quickly realized that I wanted to work in something associated with the stock market. And then I went on to study economic history at the London School of Economics, and then obviously started a career in finance, initially on the information side with Reuters, then on the brokerage side with a really high-tech electronic broker called Instinet that's still around, and then got into the exchange space via that route with the likes of Chi-X and other means, and here we are today. So it's kind of been a very interesting journey, but I realized very early on that I wanted to be in financial services. And obviously at that time, financial services was going electronic. The LSE went screen-based in 86 and then order-driven in 97, just after I graduated.
Yeah, understood. And you're still very much at the cutting edge of financial technology. And I'm just going to read your LinkedIn profile because you're holding many roles. So you're chair and CEO of GMEX Groups and SECDEX, co-chair of FinTech, vice chair of the Arabian Bourse and Max Trading, director of DAG, partner at DPM and DIF, which I guess is Digital Partner Networks and Digital Investment Fund. So I was very curious with all that, how does your normal working day works? And how do you split your time? So what's an average day for you?
Yeah, so I kind of call it. I mean, no 2 days are ever the same, and it's almost a form of organized chaos because there's lots of things coming in. But actually, whilst it seems like there's a large number of initiatives out there, they're all very synergistic and they feed off each other. So, for example, we've spoken before on Digital Partners Network and the Digital Investment Fund, but that's closely aligned to SECDEX, which is a Seychelles-based exchange. And obviously the technological backbone with all of that is GMEX. So in terms of those businesses, one feeds the other and vice versa back into kind of external partnerships. So that way, it's not as if I have to kind of stand up and kind of compartmentalize and leave one thing and go to the other. It pretty much flows during the course of the day, although there's never enough hours in the day. And it's always somewhat challenging how you juggle all of that with multiple things kind of hitting you at the same time, with multiple things to do. And then obviously, typically a day can be, minimum of 12 hours if it's a good day, but it can be kind of 15 hours, sort of more or less average day on day as well.
All right, yeah, I can imagine you have to fit that in somehow. And one of the threads I can see, aside from technology, is emerging markets, right?
Yeah.
And which was not obvious at the beginning of your career. So how did you get involved in those places that sound a bit exotic, or at least holiday places? I've been talking about the Seychelles, but also the Arabian Bourse and things like that, but for a very serious and technologically advanced project.
Yeah, although they were holiday places, and hopefully they will be again. Post
Yes.
crisis. And but no, absolutely. I mean, I often get comments like, "Oh, you're in Mauritius, where GMEX has an office, and oh, you're in the Seychelles, where we have the other ventures that I've just mentioned. I mean, it must be fantastic. I want a job like yours." Now, one of the things when I moved away from corporate to start my own ventures about a decade ago was that you could choose where you wanted to be and how you wanted to work, because it was all about kind of making a step change in the way that things were done, so that you weren't wedded to your seat, in a city office or in Canary Wharf somewhere, or albeit, maybe you're working longer than ever, but you could plan it around to some degree your lifestyle and what you did day to day. And I'm sure, to a degree, you do what you do because of that. Now, there are always challenges with that, but the advantages are that you can pick and choose the projects and the work that you want to do, and you can pick and choose where you want to do it. So, when we looked at where we wanted to be by way of offshoring and things like that a few years back, well, we said, okay, great, everyone's going to India, everyone's going nearshoring into Ireland, or it may be into Eastern Europe, for example, as well. But actually, we saw an opportunity in the Seychelles, one, because we were already into emerging markets and we were doing some work in Africa. So it was a good catalyst into that. And Mauritius being the same. But two, there was a good labor pool in Mauritius. It was very, very skilled in the financial services side, and also an increasing FinTech presence. And obviously, it's much more cost effective as well than the UK, but actually a good quality labor force that's concentrated. So, we opted for that. And actually, it's interesting, every time I visit these jurisdictions, I've been a number of times, and I've hardly ever been on a beach, which people find strange, but typically the financial district in Mauritius is in the center of the island. You'll arrive at the airport, go down the highway into the center of the island, and you're nowhere near a beach, or it doesn't even feel like you're near a beach.
Yes, understood. And how wonderful. I mean, it's not something, I guess, that no one could ever plan, but I guess they have an incentive to develop financial services or any other industry rather than tourism, because tourism is still so overwhelming. And today we can see how important that is, right? So is there also a push from the governments and other stakeholders to really develop those services there?
It's a fantastic question, actually, because you're absolutely right. We are really, really bullish on the Seychelles as a jurisdiction at the moment, because they have a new regulatory sandbox for FinTech. They've got an established Financial Services Act and an ecosystem there, as well as a national FinTech strategy at the central bank of Seychelles. But up to this point, they've been heavily reliant on tourism and also fisheries. Now, tourism, because they're very much into sustainability, it's priced much higher than other kind of seaside beach resorts, islands, and so forth, because they want to protect the oceans and they're very green and eco-friendly. So there's always a limit to what they can do with that. Fisheries now, to encourage sustainability, there's quotas about 2 months in the year. So they quickly realized that actually financial services is where we really need to grow and become a service economy, because we don't really produce much on the island. I mean, they're the largest, second largest exporter of tuna in the world, but that sits in the fisheries bucket. And it kind of reminded me, actually, I watched the movie that came out in 2018, Black Panther, and that kingdom of Wakanda. Now, the Seychelles has 96,000 people, but, compared to other jurisdictions, it's a fraction of the workforce. So, I remember sitting in the finance ministry and they said, look, Hirander, we have to automate and we have to embrace the fourth industrial revolution. Otherwise, we just can't do what those other jurisdictions do because we don't have the people. But actually, that works to our advantage, because with less people, we can do far more for automation and fintech. So whilst the current pandemic, given the reliance on those other sectors, has led to a level of pain, and that's the case everywhere, the UK included, where we're sat at the moment, it's actually also accelerated that opportunity, because they're starting to now look at these fintech sectors and thinking, okay, what else can we do? And there are opportunities there, whether it's digital banking to encourage SMEs, or whether it's going into the unbanked and financial inclusion as well. So it's going to be very, very exciting. And I think this could be the catalyst. There's lots of talk about African fintech, and obviously Goldman Sachs and others are investing into it as well on a selective basis. But whilst the pandemic's unfortunate because lives are being lost, I think this is going to lead to a step change as far as Africa and certain other emerging markets are concerned.
All right. Now that's definitely so much happening there right now, and it's so exciting to watch. And to go back broadly about fintech, and you've written a lot of articles as well, which we're going to link in the description of the podcast about the change that are coming. But can you tell me a bit broadly about what areas are you most excited about right now in the fintech space?
Absolutely. So right now, if we look at the pain with bricks and mortar businesses, and of course there'll be short-term adjustments even in fintech as well, with early stage companies struggling for finance, for example. But anything that reduces cost, increases efficiency, and at the same time increases revenue opportunities, and ticks those three boxes, is really going to come into the fore now. Because of course, with the crisis, revenues are potentially down, and so firms don't want to spend huge amounts of capital expenditure and also ongoing OPEX as well on initiatives. But anything that can facilitate that in a more collaborative fashion can really lead to traction. Now, where do we think that will be really exciting? We think digital assets and the democratization of finance through those means will be really exciting. And that's not just for firms, because yes, fractional ownership can encourage a wider set of investment and ownership, but also ease of transition as those assets are exchanged. But also because, for you and I, it could be game changing. For example, our data is being used all the time by a lot of these online media apps, and with different means. Even when we go into a store and pay for goods, that data is then being aggregated, and those trends are being extrapolated and sold as well. Now, that's our data. That should have value. Now, wouldn't it be great if every time our data is used in any way, shape, or form, that monetizes, and we've got a way of tracking that? Now, here's where blockchain technology combined with smart data analytics and artificial intelligence coming together can really revolutionize the way that happens, so that we can effectively monetize ourselves on a selective basis where we want to, but also monetize our data and what we produce, given that we're part of that digital economy, rather than firms profiting from our data and becoming multi-billion-dollar unicorns. So I think one thing that's going to happen now is a move into that level of collaborative fashion, where industry to really really take advantage of the data that we generate is going to have to work with us more closely. But on the other hand, if we look at that, and there are a big positive discussions to be had in terms of financial inclusion and what that can unlock as well with this. But the other thing is digital assets, if used with digital payments, if used into smartphones and tablets, can unlock financial inclusion and revolutionize access to finance that those in emerging economies or those that are underprivileged don't have day to day.
Yeah, that's what's fascinating to watch in the fintech space, because there's the technology and then there's of course profits and whatever is driving the machine, but there's real changes in people's life, SMEs and things like that. So I just wanted to zoom in into one article you wrote recently. I think it was published today. The investor, the SME, and the COVID-19, and you're calling for some changes in the way the financing of this particular sector could happen in the future. So could you tell us a bit more about that?
Yeah, absolutely. So, one thing that this pandemic will do is cause change, because we've been forced to do it in many ways. That's advantageous. We're sat here on this podcast today because of the pandemic. Otherwise, you'd likely be out filming somewhere. And now, we're doing something that's quite interesting. And actually, there's a lot of activity going on, but it's also forcing us to change the way that we do things. Because if we look at that article today, I've kind of said time for the exchanges to change or estrange. And I've been in financial markets now for over 2 decades and heavily involved in the stock exchange and wider, financial exchange space. And typically since 1997, exchanges have been essentially the same model, today that we've seen back then. Now, everyone thinks that the emergence of digital assets and digital trading and blockchain will revolutionize exchanges. But all that these existing exchanges are doing, or even new exchanges are doing, is taking blockchain as a concept, but really not using it in a revolutionary sense, a bit like we saw that the internet revolutionized what we're doing today, including this podcast, for example. All they're doing is applying it to that old construct. Now, I fundamentally believe that that is going to change. And as we harness change in the right way, and now we have the technology to do it, and it's evolving rapidly every day, then that exchange model is going to change. Now, the issue being, we've seen this, and this is a problem that's inherent both in developing economies and developed economies like the UK. All of a sudden, the crisis has made cash flows very tight, and they've dried up in many cases. And as a result of that, access to finance is needed. Yet even with 80% government-backed guarantees, the banks aren't lending fast enough. And actually, post the financial crisis in 2008, the banks reduced their lending to SMEs anyway. So it's becoming increasingly difficult to get a loan. Now, if we look at stock exchanges, it's great if you're a company that's got some level of establishment, whether you're a small SME company or you're a blue chip. Then you can go to the stock markets to raise finance, but it comes with massive overhead and cost. And of course, tokenization and using blockchain now can revolutionize that and make it more cost effective. But actually, we're seeing initiatives being offered that are either non-trustworthy and unregulated, or even if they are, they're more expensive than IPOs. And how can that be when technology is supposed to lower the barriers to entry, reduce intermediaries, and lower costs? So what we're saying is actually exchanges have to now say, well, actually, we've been catering for a certain segment today, but how do we now also extend the model into crowdfunding, into giving a wider range of investors and not just a select few access to what we do in the same way that these privileged wholesale investors get access, but also how do we use it to really change the way that we're doing things so that finance for SMEs, broadly financial inclusion, become part of our remit. And this is where now technology can ensure that all of that can be done from an early stage all the way through to when a company grows and becomes blue chip, rather than just at certain stages. And all of it can be interlinked. And I think the exchange can be a key part of that, rather than it being disjointed out there. So it can act as that aggregator. And we're going to see this. We're already doing this with some of the initiatives like SECDEX that you mentioned in the Seychelles. But we now see the exchange of tomorrow being a virtual representation of a network of multiple exchanges, rather than one single exchange.
Now that's a really interesting perspective, because it seems like the whole discussion about IPOs was, well, there's been debates about whether IPOs are good for the investor, good for the final investor, good for the company. Now there's a trend of direct listing, but none of this is groundbreaking, right? Whereas what you're talking about is really giving access to a different kind of a whole different segment, right? Not just unicorns. So could you tell us a little bit more about what are the first steps that are being taken, those initiatives that you mentioned?
Yeah, absolutely. So if we look at now, we've developed a really interesting piece of middleware, because the problem is when you've got lots of disparate markets, even if they go digital, moving assets between those markets or where those assets are held under custody at those markets or elsewhere is incredibly difficult. If you look at you as a private consumer, you have multiple savings accounts, and obviously moving between them or opening new bank accounts is difficult on the one hand. But even for wholesale investors, when they open up accounts at exchanges, those accounts are very fragmented, and that's no different whether these are established traditional exchanges or whether they're digital exchanges as well. Now, in this modern era of technology, whether you're running a private blockchain into a public blockchain, or whether you're running both, or also linking that into traditional markets, networks exist, and the ability to interoperate those networks through technology also exists. So why is it not the case where, okay, I might be on a mobile network and I'm using Vodafone, someone else is using Airtel, but we can still talk to each other and it's seamless. I don't need to know that you're using Vodafone or that I'm using Airtel or vice versa. Now, whereas in markets, that flow of assets isn't seamless. And that has a knock-on effect, whether you're a retail consumer trading in these markets indirectly, or some of the new digital markets directly, or whether you're a wholesale consumer. And it's very, very high in cost as well, navigating that. Now, what technology fragments, technology can also knit together. So in that sense, now the technology that exists, including that we've developed, allows that to happen. So you can have multiple markets and multiple custodians, as well as other services, interconnected and talking to each other. So, what does that mean? It's smart contracts are a word that's been mentioned quite often with blockchain. Now, that form of physical contracts or standalone electronic contract can now transcend jurisdictions, assuming those jurisdictions from a regulatory standpoint are allowed to interact with each other, for whatever reason. So, all of a sudden, if I have Bitcoin or in one jurisdiction and you have a digital security in another jurisdiction, we'll be able to swap that with each other, either decentralized or through exchanges. But equally, if we can't get banked in that particular jurisdiction where we've effected a swap, we can also back that into fiat currency through another smart contract into another jurisdiction. And that flow then becomes seamless. So we're now beginning to transition to that. And it's in the early stages, but as smart contracts develop, as blockchain becomes more widespread, as use of data, this is where AI analytics come in, drive those smart contracts, because the smart contracts are only as good as the data that feeds them, and that feedback loop. This is going to become mainstream and commonplace as we progress. And the crisis is mainly going to exacerbate that, expedite it effectively.
Oh, that's quite a mind-blowing perspective. And who do you think is taking the lead or should take the lead in terms of bringing this forward? And I know you're not just talking about it, you're also an actor in this space, but is it, I don't know, the exchanges, the specific startups? Where do you see the most, what do you see driving the initiative really?
This is an excellent question, because, there's various pockets of innovation happening. Now, we'll take a skeptic's view and a non-skeptic's view as well. Now, the skeptics will argue, well, great, if the large banks and financial institutions are making huge amounts of money based on current networks and the current financial system and the current way of doing things, and that includes everything from credit card fees to remittance costs and everything else, why is there a need to change? Because surely they're going to hold out for as long as it takes and protect that revenue base. But we've seen this in other industries. I mean, look at how well established even a decade ago Blockbuster was, and look at what Netflix did to it in a heartbeat. And other video streaming sites have also emerged since. Now, we know that that goose that lays the golden egg won't be there forever. And effectively, by not innovating, institutions will either be superseded by a better way of doing things, or other existing institutions will innovate because they realize that better to do it themselves rather than be disintermediated, because they can then adapt the model. So that is very, very interesting because we're beginning to see that step change of innovation happen in existing financial markets, where large banks are now looking at digital assets. They're establishing innovation funds, and they're saying, well, okay, innovation from the inside out might be more difficult because of those inherent challenges of protecting business. But yes, let's do some of that, but let's also encourage innovation from the outside in. And also let's see how we can work with fintechs to see how we adapt our models and also adapt the fintech models into something that's new with that construct in the middle. And we certainly see that as interesting because, you've got the fintechs that aren't affair with regulation on the one hand, a lot of them, some are. You've got the established financial institutions that are overburdened with regulation as well, but also overburdened with technology costs of legacy systems and everything like that, and sometimes a lack of innovation. So, we began to see fintechs and large corporations work together post the crisis, and as a result of the crisis, that's going to accelerate as well because the fintechs will struggle to remain standalone, especially the early stage ones, because they're going to need support simply because there's a prolonged route to market or funding is drying up to a degree, and those larger firms will realize now that the need for automation has to happen sooner than they thought. So we're going to see a lot of collaboration where the new world combines with the old world, and much like we're seeing with our own initiatives, the right answer is somewhere in between. And that's really, really exciting now, as far as financial markets, but also things that more broadly are concerned.
Yeah, this is what you mentioned about collaboration, fintech, and established players. Something now I hear more and more, and really true in the B2B space, right? Otherwise, fintechs are doing incredible advances, direct to consumer with their app, etc. But in the B2B space, this seems to be the way to go, and people are actually embracing it. And it's just like now everybody's trying to catch up with Netflix, but imagine if, I don't know, TV channels or whatever were actually trying to collaborate with these crazy guys that had a weird idea of doing it differently earlier on, and now they were partner and in a much better position. So it seems like, the industry seems to be really understanding that things are changing and generally positioning themselves to be, well, at least to have one leg or one, and to be a bit of a part of it, right?
Yeah, I mean, this is interesting. It is, and you're right. It's one leg in, one leg out in some cases because I can't mention the bank, but I'll give you something interesting that happened to us recently. With those jurisdictions like the Seychelles and Mauritius that we mentioned now, obviously there's a level of banking there, and some established banks and also neo players emerging. But we've got certain correspondent banks, to bank activity from there into other jurisdictions, whilst they have their own fintech activity, and they're spending a lot of investment into that as well, and undertaking that in-house and investing externally as well. They're now saying, well, we're not going to enable fintech businesses as a matter of policy. Now, that's really interesting. We're not talking here crypto businesses, and to me, crypto is not an issue because, if you apply the same level of equivalence in terms of KYC and AML that you do in traditional finance moving money, then actually whether you're handling a crypto asset or you're handling traditional money, it shouldn't really matter. It's all about equivalence. But here they're saying, well, it's the bank's policy not to enable fintech. Now, to me, that's anti-competitive rather than anything that they're concerned about, because they feel that, okay, if you're holding things in digital wallets and you're moving virtual money that's backed by assets in a bank account between those wallets, and that way you're netting things off and you're settling less out into the banking system than those individual transactions, that reduces banking revenues, and payments has been a big cash cow for the banks because it's all being done digitally and it's being done securely, utilizing bank accounts, but without the need for the banks on a per transaction level. And this is what the banks have threatened about, many of them. But actually, this is a future, you can't avoid it. Digital banking is now coming to the fore as well. The cost to income ratios of traditional banks are far higher than going digital because there's no legacy employee or system costs. So this is something that, that the traditional banks themselves have to embrace. Now, you mentioned B2B. But this change is also happening on the B2C side. Now, of course, you've got some of the neobanks that have been emerging in the UK, but you've also got well-established investment banks, with history that are now seeing where the market's going. So Goldman Sachs, for example, have set up Marcus as a bank in the UK. Now, again, there was press news out there that one of the large exchanges, Intercontinental Exchange, was looking at whether they wanted to buy eBay or not. But their shareholders then said, look, this isn't something that we want to go in. And, the likes of Goldman Sachs have also looked to see how they can partner with Amazon as well on various fronts. So this is really, really interesting because, to date, retail has been very much standalone from wholesale, but actually wholesale markets now are looking at, well, okay, how do we increase revenue streams? How do we deal with this democratization in a way that will, improve our bottom line as well and reach out to a wider audience? And that's now meaning that wholesale markets and B2B are now going to increasingly start to interface with B2C. And you're going to see a new wave of construct that, again, is dual and hybrid across both those in a single construct. Because, the Facebooks of this world and others have a large user base, but, the banks have a large capacity for financial markets and the way to do things cross-border. And both of them together becomes a really powerful construct. So it's not the end of it, actually, it's the start of it. And we're going to hear a lot more in this space as well.
Wow. Well, that's definitely something that we could discuss further for a long time. But let's try to just do a mental exercise if you want. And that would be my final question in the FinTech space, in terms of if we clear all the hurdles, or you got a magic wand and you can make it happen, or we just jump in the future. How do you see this, development of digital asset and investability? And let's just talk about that, the investability for SMEs. How do you see it developing in an ideal world?
Sure. So with SMEs now, the idea being, having been an SME and then a growing company, and also starting new startups and those growing, the biggest challenge for any entrepreneur is access to finance, and the whole process is antiquated because, okay, great, reaching out and knowing those advisors that you need to reach out to, and they may be charging even before you get to raise, or even there's legal fees and corporate advisor fees even if you're listing on a stock exchange. It's a little bit of a chicken and egg problem, but also just seeing how you can reach out to the end investor has been a massive challenge actually to date, and it's very, very manual, it's very, very antiquated, and it's the same way that things were done decades ago. And it's built on relationships. Technology allows investor platforms now to bring together those that want to invest in products and those that have products, whether it's investable companies or other forms of products available to sell. That could be equity investment, it could be debt investment, it could be the creation of new forms of token vouchers, whether it's loyalty being more easily traded. So tokenization allows a fungibility of these different types of assets. So for example, now, if we look, okay, ICOs were misused, initial coin offerings, but that allowed Bitcoin and other digital assets, cryptocurrencies, to be invested against a network effect of SMEs or even security tokens as well. And it allowed access into those investments for those that were not necessarily always within the financial system. Now, we're increasingly going to see this, but we're going to see now much more in the way of automated platforms, that those platforms are going to connect to each other, because you can't be a jack of all trades. We might be good at one thing, another platform might be good at another. So for example, this morning I had a discussion with a trade finance platform. They've got a great business model, but we can offer them digital custody on our side and the ability to go into payments, and also to trade, to offer those assets out in digital form onto the exchange that we have. Now, when you combine the two, you can do much more together collectively that you otherwise wouldn't have been able to do, and unlock revenues together. And that network effect then, as you combine more of these individual nodes, becomes a network of network effects. So we're very much going to see that 1 + 1 = 11 construct, where in a collaborative sense, everyone's looking at their own ventures, but we're doing things much more collaboratively and unlocking new revenue streams as a result. But ultimately, we're also going to see now as we mentioned at the start of this interview, much more control for the end consumer, where the end consumer, the C side of B2C or C2C, there's a lot more interaction, and there's a lot more opportunity for them to earn revenue out of their own activity on these platforms, rather than be just users who benefit from a usability perspective. They can benefit whether it's then being able to invest, whether it's being able to exchange assets, or even being able to create new assets that others invest into as well.
Wow, that's quite a fascinating perspective. Imagine if we could, from the source, from the activity of the company, all the data is recorded, analyzed, processed somewhere, to the investor who has access to this data, but also can access it in a totally different way. So that's quite it's something I've never considered or heard before, but we're very far away from the typical startup advice on how to build a better pitch deck. Okay, and we're still there, right? So many years later. Wow, yeah. Thank you so much. This has been, it's something that I'd love to perhaps rediscuss at another stage, because there's so much to talk about here. But let's instead try to wrap it up, Hirander.
Sure.
And we're just going to finish with some lighthearted quick-fire questions. So if you're ready for this, the first one is, what would you do if you were to choose a completely different career path or start again?
I'd become a chef. I've got a real passion for food. And I'm just really, really excited about creating something with different ingredients and putting them together and experimenting with that. So I'd probably be some kind of mad chef. I really admire the likes of Heston Blumenthal and others in this space, because I think there's incredible talent there, and it's always undervalued as well. So there you have it.
Amazing. Before switching back to finance and fintech, I was working with chefs, and we filmed Heston Blumenthal, and all the Michelin stars, but sadly, I wasn't that much into it. And the intellectual challenge of finance is, suits me better, but a great answer. Thanks very much. Well, maybe that answers the next one as well, but hidden talent?
Well, actually, it's more a facet in that I sleep about 5 hours a day, actually. So, as we mentioned, the hours can be long, but actually I find whether I sleep 3 hours a day, 4 or 5 hours a day, I'm still fresh and alert and wired for the remainder of the day. So sleep's never been a great need. Now, they always say there's studies out there where they say actually less than 7 hours a day reduces your lifespan, but I don't smoke, so maybe it will offset.
Because you look nice and fresh. That's incredible. I do think it's definitely a talent or luck, because I've seen somewhere that it's one of the most unequal things among humans. Some need X hours of sleep, and some need a lot less. So like you. So now I get why you have all those jobs on LinkedIn, all those functions.
You've got to do something with your time, right?
What are the things you couldn't do without while being confined?
Luckily, the house was done up a while ago, and a built-in coffee machine was installed. So, I like my daily coffee a couple of times a day. So I've got a great coffee machine and access, obviously thanks to online delivery, with great coffee beans. So that coffee in the morning, it's a godsend, and you look forward to it, actually.
I get it. Yeah, I can completely understand. Fantastic. So a couple of things that we cannot do right now. So what's your favorite place to go on holidays?
Well, actually, I'm fortunate because, in terms of destinations, I've always been a beach holiday guy. And I love destinations like the Maldives or the Seychelles as well. And so, visiting Seychelles on a work basis is always a pleasure, even if it's less so beach. So I'm looking forward to the embargoes being lifted, flights being started, and being able to combine business with pleasure. And this time I will go and see the beach because I think you start to value the things that you are deprived of most, right?
A lot to look forward to. Hirander, that's been really fantastic, really a glimpse into the future. Thank you so much for your time. It's been
my pleasure, George.
Thanks for listening, and thank you to our guests who make this possible. Subscribe to never miss an episode. As this is a new broadcast, if you could give us a 5-star review on iTunes and your favorite podcast player, that would be great. Let's work together to accelerate FinTech towards the 2030s.